Welcome to Explain the Charts, your go-to channel for deciphering market movements. Today, August 4th, 2025, we're zeroing in on the SPY, the popular ETF that tracks the S&P 500, to provide you with an in-depth analysis of both the current news and the underlying chart data. The past few days have been a roller coaster, with significant headlines dominating market sentiment. Just a few moments ago, newswires reported that stock futures are climbing, indicating Wall Street is attempting to recover from a sharp sell-off. This recent downturn was largely triggered by a dire jobs report and concerns surrounding new Trump tariffs, creating considerable uncertainty for investors. In fact, the S&P 500 experienced one of its worst days since May just a few days ago, on Friday, August 1st, after the release of that week's jobs data. The news highlighted that the index closed below its 20-day moving average for the first time in over 65 days, a significant technical breach signaling short-term weakness. However, it's crucial to remember the broader context. Only about a week ago, both the S&P 500 and Nasdaq were hitting fresh record highs, demonstrating robust underlying strength before this recent shock. Now, let's turn our attention to the charts to see how these events have manifested in price action. Looking at the daily chart for SPY, we can clearly see the longer-term bullish trend that has been in play, with the price steadily advancing for much of 2024 and early 2025. However, if we zoom into the period around April 2025, we observe a dramatic spike in volatility. The market experienced a sharp sell-off, with SPY plummeting from around 564 down to an intraday low of 481.8 on April 7th, marked by exceptionally high volume, indicating panic selling. This level, near 481, now stands as a critical long-term support level should we see a significant pullback in the future. Remarkably, the market then saw an equally aggressive V-shaped recovery, bouncing back to 548.62 within just a few days, demonstrating strong underlying buying interest at those distressed levels. This period serves as a powerful reminder of how quickly sentiment can shift and the importance of identifying key price floors during periods of extreme fear. Fast forward to the most recent data on our daily chart, specifically the candle for August 1st, 2025, and you can see a large red candle opening at 626.3 and closing significantly lower at 621.72. This plunge correlates directly with the dire jobs report and tariffs news, marking it as the worst day since May and confirming the break below the 20-day moving average that was widely reported. This candlestick's large body and high volume, at over 140 million shares, signals strong bearish momentum entering the weekend. Now, let's examine the hourly chart to get a more granular view of this recent sell-off. As we shift to the 1-hour time frame, focusing on the last week of July into early August, a clear downtrend becomes visible after SPY peaked around 637 on July 25th. We can see how successive lower highs and lower lows have formed, indicating persistent selling pressure. The market struggled to maintain levels above 635, which acted as immediate resistance, before breaking down further. The candles on July 31st and August 1st show a sustained move to the downside, with a particularly sharp drop occurring late on July 31st and continuing through August 1st. This confirms the momentum shift, with sellers firmly in control during that period, driving the price towards the 620 to 622 support zone. The significant increase in volume during these hourly drops underscores the conviction behind the selling. Let's get even more precise by looking at the 15-minute chart, which reveals the intraday nuances of the breakdown on July 31st and August 1st. Here, you can clearly see the multiple attempts by bulls to hold minor support levels, only for them to be decisively broken by renewed selling. Specifically, the sharp declines around 13:28 Universal Time coordinated on July 31st, where price dropped from 635.95 quickly to 635.595, and then later that day, The steep fall from 634.48 to 631.54 at 1843 Universal Time Coordinated illustrates significant bearish impulses. On August 1st, the pattern continued, with another sharp drop from 625.49 to 622.61 around 1328 Universal Time Coordinated. These rapid declines, coupled with heavy transaction volume, suggest large institutional selling or programmatic trading reacting swiftly to the negative news flow. So, what does this all mean for SPY moving forward, especially given today's news of futures attempting a rebound? Returning to our daily chart, the close at 621.72 on August 1st is an important immediate support level, a test of previous consolidation zones from early July. The bullish case for SPY in the short term rests on this reported futures rebound translating into actual market strength. If SPY can hold above 620 and reclaim the 625 to 630 range, it would signal that buyers are stepping back in after the panic, potentially forming a double bottom or a new higher low. The likelihood of this occurring depends heavily on upcoming economic data, particularly any revisions to jobs figures and further developments regarding trade policies. Long term, as long as SPY remains above the 550 level, the overall uptrend from the April 2025 recovery is likely intact. Conversely, the bearish case hinges on the current weakness persisting. If SPY fails to hold the 620 level, we could see a retest of 610, a support level from early July, or even a move down towards the psychological 600 mark, which served as strong support in late 2024 and early 2025. A breach of 600 would be a major concern, potentially leading to a deeper correction towards 580 or even the 481 long-term support. For traders, key price levels to watch are 620 as immediate support and 625 to 630 as immediate resistance. A sustained break above 630 could see SPY challenging its July highs around 637. A break below 620, especially on increased volume, would likely open the door to 610 and then 600. Keep an eye on volume as well. Strong buying volume on upswings, especially above resistance, would reinforce a bullish outlook. Conversely, high selling volume on downswings, particularly below support, would confirm a bearish continuation. Also, pay close attention to news releases this week, particularly any further updates on jobs data or trade policy, as these can quickly shift market sentiment. Stay vigilant, manage your risk, and adapt your strategy as new information becomes available. That's all for today's in-depth analysis on SPY. We hope this helped explain the charts for you. Don't forget to like, share, and subscribe for more market insights.